Hi everybody, welcome back. Now we're going to talk about second chance entries, something I like to call on the rebound. What is a second chance entry? Well, many times you're going to miss a trading opportunity. You already know how to trade certain patterns, but that initial move, that initial break on the pattern, it's easy to miss. Sometimes the price gaps right past your entry point, or sometimes you just don't spot the opportunity until it's too late. It's going to happen. And that's a reality of trading, but luckily many of these patterns will give you a second chance to enter. Often those second chances are superior entries to the first chance. So don't worry about the trades you miss. You're always going to miss trades. I miss trades all the time. Don't get into this mindset that you're losing money because you missed a trade. Hey, maybe you missed a trade that wasn't going to work out. Okay, you don't know that. So don't worry about the things that you miss. What tends to happen is people get so worked up about missing out on something, and at the same time, there's opportunities all around them. But because they're focused on the wrong thing, they're not going to see those opportunities. So I want you to get out of the habit, if you're in that habit. Lose that habit of worrying about trades that you missed. There are an infinite number of trades to place. That is never going to be a problem. Okay, there's always going to be another trade on the way. Now, let's talk about a second chance entry for the head and shoulders pattern. All of our patterns, head and shoulders, double top, triangle breakdowns, they sometimes return to the point of entry. It does not always happen. There's no guarantee that it'll happen. But when it does, it can be a superior setup. So if we miss that entry, we can use the same setup for our second chance entry. In other words, the height of the pattern hasn't changed. Okay? And if you know the height of the pattern, then you know where to place the entry, where to place the stop, and you know where the targets are located. You know all that stuff if you know the height of the pattern based on everything we've learned up to this point. The only difference in this case might be the order type. Okay, so for example, instead of a stop entry, which we use for breakout trades because we want the price to break up for a long entry or break down for a short entry, if we miss a trade on, say, a head and shoulders breakdown, that's no longer a stop entry. That's now going to be a limit entry. Why is that? Well, just refer back to your order entry section. If the price has already moved down, now we need it to rebound up so we can get short. And that's a different order type. That's a limit order. But other than that, everything remains the same. The targets, the entry price, the stop, it's all the same. Now, here's a head and shoulders setup. You can see that this particular stock has had a nice run up and then formed a head and shoulders pattern. We've got our entry, we've got our stop, we've got our targets. The height of the pattern, $50. 10% of $50 is $5. Okay, so the entry is $5 underneath the neckline. 650 minus 5 is 645. Our entry point is 645. The stop is $5 above that neckline. The stop is 655. For targets, we're going to measure from support. Half of the height of the pattern is $25. Measured from the neckline, 650 minus 25 gives you 625 for target number 1. Target number 2 is equal to the full height of the pattern. 650 minus 50 equals 600. Target 2 is 600. It's the same method that we used in the previous chapters. And here you can see, right, the price is going to break down out of that head and shoulders. But you know, maybe you just didn't see it. Maybe you just didn't catch it in time. Maybe you just weren't there that day. Maybe something came up. Under any conditions that you missed it, you want to save that setup. You want to keep that setup in mind. Now you can see several days later where the arrows are located on this chart, the price comes up, right back up to the entry point. So even if you missed it the first time, you get a second chance. And a few days after that, there's a third chance. So there were plenty of opportunities to short this stock out of this head and shoulders. It wasn't just one and done. And in fact, those second chance entries, well, you can see how things turned out. So that can work very well, but why does it work? If you think about it this way, that neckline in the Head and Shoulders, until that Head and Shoulders breaks, that neckline is support. The price keeps coming back down to that level, back down to it. It's a support level. Once it breaks, support becomes resistance, and what we're doing is we're using that resistance to place the trade. We're expecting the stock, if it comes back up that way, to hit that resistance and counter that resistance, and then hit that and drop again. And that's exactly what occurred in this example. Now, in this trade, we used a $600 stock. Does that mean that we took a greater risk? No, it doesn't. Some people see that and they say, well, it's a $600 stock. I can't trade that. All right, but the answer is no, it is not greater risk because you can trade fewer shares. Okay, trading 1,000 shares of a $60 stock is the same as trading 100 shares of a $600 stock. Okay, so you don't necessarily take more risk, you just simply adjust the number of shares so that you're not taking an outsized risk. Now, remember the Head and Shoulders setup that we used in an earlier chapter when I taught you about the Head and Shoulders? That one gave us a second chance. Here you see the breakdown, and it breaks down beautifully and it hits the targets. And you know, but it would have been very easy to miss this. But you know what? Almost a month later, this thing came right back up to resistance, hits the neckline and starts dropping again. And again, so even if you missed it the first time, you can catch it the second time. And I'll tell you what, if you caught it both times, you were really happy. Now, we've been talking about Head and Shoulders so far, but we can certainly use a second chance entry on our other types of patterns. For example, this is a double bottom pattern with a second chance entry. You can see the double bottom, and we simply measure it. We apply our template that we discussed earlier, entry, stop, and targets. And you can see the price takes off. If you caught the breakout, you did great. You hit your targets. But if you missed it, it gave you a second chance. A couple of weeks later, it came right back down to that level. Why? Because that resistance level on the double top, once that was broken, it then acts as support. And so, if you caught that second entry, you did very well. If you caught the first entry, you did very well. If you caught both, you did even better. Here's one last one I'm going to show you, the ascending triangle. We have an ascending triangle trade here, and there's a breakout, and it makes it up to the first target. And over a period of several weeks, this gives numerous second chances, 5 or 6 times. The price comes back down to the entry point and allows you to get back in. So if you missed the first one and caught the second one, you did great. And so, again, why does it work? Because we're talking about support and resistance levels, which is a fairly basic concept. But it's an extremely important concept, and we can see from these charts examples of that concept working really quite nicely. Is it going to work every time? Of course not. I would never want you to think that there's any strategy that's always going to work. But if we apply what we know and use it properly, then we're going to get a lot of successful trades by taking these second chances that the market gives us.